Merchant battery storage plants in 2026 often achieve internal rates of return exceeding 20% by alternating between wholesale arbitrage and sub-second frequency response within the same settlement hour. Revenue stacking refers to the strategic utilization of a single battery asset to serve multiple financial streams simultaneously, ensuring that the system never remains idle during periods of low market volatility. The foundational layer is energy arbitrage, which involves charging the battery when electricity prices are near zero or negative, and discharging when demand peaks cause prices to spike significantly. Intraday markets offer higher granularity than day-ahead auctions, allowing batteries to capitalize on sudden supply drops caused by unexpected changes in wind speed or solar cloud cover. Frequency containment reserve requires the battery to respond within milliseconds to grid deviations, making lithium-ion systems the most efficient tools for maintaining the 50 Hz standard across continental networks. Automatic frequency restoration reserve offers higher energy payments, but demands longer sustained discharge periods, which requires operators to carefully manage their remaining state of charge to avoid penalties.
Capacity markets provide a fixed monthly revenue stream for guaranteeing that the battery will be available during extreme system stress events, regardless of whether any energy is actually delivered. As balancing service providers, battery operators minimize financial penalties for renewable energy producers by absorbing the difference between forecasted output and the actual real-time generation of green energy. Every charge and discharge cycle causes electrochemical degradation, so optimization algorithms must constantly calculate if the marginal revenue of a trade exceeds the long-term cost of cell replacement. Maintaining the state of charge between 20 and 80% prevents accelerated chemical aging and ensures the battery has enough headroom to accept sudden surplus energy from the grid. In systems with locational marginal pricing, batteries placed at congested nodes can earn premium rates by resolving local bottlenecks that would otherwise require expensive physical transmission line upgrades. Co-locating batteries with solar farms reduces curtailment losses during peak sunshine and allows the project to share a single grid connection point, reducing overall capital expenditure by 15%.
During periods of extreme wind, oversupply electricity prices can turn negative, meaning the battery operator is paid to charge their system, essentially receiving both free energy and a service fee. New regulatory frameworks in 2026 have eliminated double grid fees, which previously taxed batteries as both a consumer when charging and a producer when discharging to the network. Artificial intelligence models analyze historical weather data and industrial demand patterns to predict day-ahead price spikes with an accuracy level that human traders can no longer match manually. High-frequency bidding bots submit thousands of micro-offers to the intraday market every second, capturing small price spreads that aggregate into millions of euros in annual revenue for the operator. Capacity market regulators apply derating factors based on discharge duration, which means a 4-hour battery system receives a much higher payment than a 2-hour system for the same capacity. While pure merchant models capture the highest upside, floor price contracts are often used to provide a minimum guaranteed revenue level, making projects more attractive to conservative debt financing providers.
Advanced liquid cooling systems enable higher charge and discharge rates, allowing the battery to cycle more frequently without reaching critical temperatures that would trigger a safety shutdown or accelerated wear. Local flexibility markets allow distribution system operators to pay battery owners for reducing load at specific substations, preventing transformer overloads during peak local demand periods in residential neighborhoods. Virtual power plants aggregate thousands of small residential batteries into a single logical unit that can bid into large-scale wholesale markets, providing decentralized grid support with centralized control. Iron flow batteries and other long-duration technologies are emerging to handle multi-day energy shifts, providing a critical backup during seasonal periods of low renewable energy generation, known as Dunkelflaut. Contemporary warranties have shifted from simple time-based duration to total energy throughput, allowing operators to cycle the battery aggressively as long as they stay within the total megawatt-hour limit. Market success depends on low-latency telemetry, where sensor data from the battery travels to the trading server and back in under 50 milliseconds to capture fleeting price opportunities.
Batteries are increasingly compensated for providing reactive power to maintain grid voltage levels, a technical necessity as traditional synchronous generators like coal and gas plants are decommissioned. Specialized insurance products now cover revenue shortfalls if market volatility stays below predicted levels, or if technical outages prevent the asset from fulfilling its lucrative frequency response contracts. Standalone storage projects benefit from significant investment tax credits, which can reduce the effective capital cost by 30% or more, accelerating the path to project break-even. Asset managers plan for future augmentation by designing battery enclosures with extra space to add new cells in year 5 or 7 to compensate for the natural loss of initial capacity. Modern safety standards require integrated aerosol fire suppression and explosion venting to mitigate thermal runaway risks, making large-scale storage installations safer for placement in densely populated urban centers. Large developers are vertically integrating with battery manufacturers to ensure a steady supply of cells and to gain deeper insights into the chemical properties of their specific storage hardware.
Batteries with black start capability can provide the initial energization needed to restart local grids following a total blackout, a premium service that adds another layer to the revenue stack. Engineering and construction contracts focus on round-trip efficiency, which measures the energy loss during the conversion process from alternating current to direct current and back during operation. By displacing fossil fuel peaker plants, batteries can generate carbon credits, which are traded in environmental markets, providing an additional 3 to 5% in annual revenue for the project. Lithium iron phosphate has become the preferred chemistry for stationary storage due to its superior cycle life and lower risk of fire compared to high-energy density nickel-based alternatives. Modern energy companies maintain specialized trading desks where data scientists and traders continuously refine the algorithms that manage the battery's participation across dozens of different power market products. Optimizing the duty cycle involves selecting the most profitable service at any given moment, while avoiding high-stress operations that would void manufacturer warranties or lead to premature hardware failure.
Hybrid power purchase agreements allow developers to sell firm energy blocks at a premium because the integrated battery can guarantee delivery even when the sun is not shining or wind is calm. Behind-the-meter industrial batteries perform peak shaving to reduce expensive demand charges from the utility, which can account for up to half of a large factory's total electricity bill. The levelized cost of storage is the primary metric for comparing different technologies, accounting for capital expenditure, maintenance costs, and the efficiency losses incurred over the entire life of the asset. New market products for fast frequency response are designed specifically for the millisecond response capabilities of batteries, allowing them to replace the mechanical inertia lost as coal plants retire. Repurposing electric vehicle batteries for stationary storage provides a lower-cost entry point for projects that require less frequent cycling, such as backup power for commercial buildings or remote microgrids. Closed-loop recycling systems are now recovering over 95% of the lithium, cobalt, and nickel from spent cells, creating a sustainable circular economy for the critical minerals in storage. The long-term profitability of a battery depends on a modular software stack that can quickly integrate new revenue streams as market rules and grid requirements evolve over the next decade. Securing a grid interconnection point remains the most significant hurdle for new projects, with waiting times often exceeding 3 years in high-demand regions like Western Europe and parts of America. By diversifying across different geographic regions and market types, storage developers insulate their portfolios against localized regulatory changes and ensure stable returns in an increasingly complex global energy transition. Trading algorithms align battery operation with 15-minute or 5-minute settlement periods to ensure that every kilowatt-hour discharged is captured at the highest possible market price point. Redundant sensors and localized cooling prevent cell-level faults from escalating into full-rack thermal runaway, ensuring the safety and continuous availability of multi-megawatt battery installations for the grid. Success requires strategic bidding under uncertainty, where the optimizer must decide whether to commit capacity to a fixed reserve contract or gamble on the potential volatility of the spot market.
As the backbone of a zero-carbon grid, revenue-stacked batteries provide the flexibility needed to integrate variable renewables while maintaining the high reliability required by modern industrial societies.